Okay, so to take the measure of the currency powers at play at the moment with CIBC World Markets Executive Director Jeremy Stretch. Jeremy, thanks very much indeed for coming in. So now we've had G20, we've had APEC, and seems to be very little progress on actually addressing these global economic imbalances that we keep on talking about that led to the financial crisis.
Absolutely. We get the warm words from the communiques, but it doesn't really add anything new to the underlying developments. Yes, we know that countries are saying they don't want to be involving in competitive devaluations. We don't want currency manipulations. We want markets in line with fundamentals. But the reality, of course, is somewhat different. And, of course, the process continues to be kicked further into the middle distance, looking towards the IMF and G20 next year now. So it's more or less the continuation of the status quo.
Can we expect much movement from China on the yuan off the back of G20?
I think it's very much a case that the Chinese will do or conduct policy in their own particular interests. Now, if you think that China has a nascent inflation problem, then perhaps that would suggest they could be happy to tolerate a gentle appreciation in the currency. But I think it will be very much on their own terms rather than necessarily being pushed by international pressure.
And speaking of an inflation problem, Chinese stocks falling at the moment after a report saying that the largest banks have stopped new loans to developers. Is further monetary policy tightening on the cards in China?
I think it probably is. If you look at the level of bank lending, if you look at the money supply, and then if you layer in the inflation issue, then I think it does suggest that the Chinese authorities would probably be much happier just to take a little bit of froth off the domestic economy. And that obviously implies more monetary tightening, but also that has implications for those commodity space currencies and general currencies within the region.
So when might we see an interest rate hike?
Well, I wouldn't rule out one before the end of the year. Certainly, there were the rumours were going around at the end of last week that we could have seen one as early as that. I think it was probably a little bit preemptive, but I wouldn't be surprised if we do get a further tightening before the end of the year, just as I say, to try and slow down or take some of the froth off the market.
Now, we had a reiteration in this G20 communique about countries pledging that they wouldn't intervene in markets to devalue their currencies to gain a competitive advantage. But, of course, after the first G20 statement making this pledge, the US engaged in QE too, so...
Well, of course, the US would argue that that's not involved with currency manipulation. That's very much involved with domestic policy. But, of course, we as participants in the market probably perceive that QE is part of that process is to have a weakening dollar.
Will it depress the dollar?
Well, I think it did in the expectation. I think it was all about managing expectations. So we saw the expectation of QE2 going over the last couple of months. We've now gone through the actual announcement process. It mildly bigger QE than anticipated. But I think if the data actually comes in a little stronger, maybe the retail sales numbers being part of that today, then the actual scale of QE could be actually smaller than perhaps the market had been perceiving. And I think that negativity that was really afflicting the dollar in September, October could well start to unwind.
Jeremy Stretch, thank you very much for coming in.
Thank you.
Good to get your thoughts.